Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, last week I talked about the bond market buckling, and what we've seen this week is a continuation of that pattern and the impact that's now having on equity markets more widely. So if you want to find out what's been going on with bond markets and why, go back and listen to last week's episode because there's a lot of content in there where I explained what's actually going on in terms of mechanics. But fast forwarding now to this week, what we've seen in equity markets is key areas have shown some real signs of weakness, and we've seen a pullback, particularly in technology stocks, which I'll come on to in a bit. But that has now started to spread into the wider market. And if you look at the S&P 500, for example, in the last week it's down around about 1.5%. But when you take into account the movement of the pound, that's down around about 3%. And what we've seen is that the more speculative areas of equity markets have seen a real pullback. So Tesla, for example, is down around about 18%. But we've seen other areas of investment markets more generally that are more speculative pullback as people start to become a little bit more risk averse. And so a good example of that is Bitcoin, where we've seen the price of Bitcoin fall by about 20% at its worst point in the last week. And at the moment, as I make this video, it's down around about 12%. Now, if you look at the wider equity markets, the FTSE 100 is down around about 1% in the last week. The Japanese stock market is down around about 1% in its own currency, but down around about 0.4% when you factor in the currency exchange rate. As I said, US equity markets generally are down around about 1.5% if you look at the S&P 500. Asian equity markets are down around about 3% in their own currency, down around about 5% when you factor in the impact of currency movements because the pound has been strengthening. And the Nasdaq 100, which is the tech-heavy index in America, is down around about 3.5% in its US dollar currency terms, but down around about 5.5% when you factor in that exchange rate for UK investors. So you can see that emerging markets were in that mix as well. Actually, they were down around about 3% and 5% in pound terms, a bit like Asian equity. So if you look at that broad range, you can see there's been a bit of a risk-off element to markets, but it's been very targeted initially, because if you look at the Dow Jones is actually up on the week 0.4% if you take it in US dollar terms. So what we're seeing, firstly, we're seeing a bit of a rotation. So we're seeing something like we saw back in November when we had the vaccine first announced, and we saw a rotation into those value plays out of growth stocks. We're seeing that happen once again. So if you've got any value exposure in your portfolios, that would have done particularly well this week in comparison to growth stocks like technology stocks in the last week. And now, part of that is due to the reopening we're hoping for in economies around the world. Like, just take the UK, for example. We've already got this roadmap to freedom, and it means that the pound has rallied off the back of that. We're up around about $1.41. It's also strengthened against the euro. So that's had an impact on your overseas holdings, as I've explained previously, when you convert them back into pound terms. Now, that strengthening of the pound has been something that has meant that if you sheltered into UK equities, particularly the FTSE 250, then you won't have seen that exchange rate hit your returns. And also the FTSE 250, for example, UK small caps have done very well this week because of that hope of the reopening of the UK economy. So that part of your portfolio will have done well, despite the fact that technology stocks haven't done so well. Now, that is the beauty of diversification. So weeks like this show the benefits of that diversification in your portfolio. So why have technology stocks in particular been hit? It goes back to the rising yields that we're seeing. Now, yields are still increasing from last week. We've had the US 10-year Treasury yield go up to about 1.39. We've seen the UK gilt yield go up to about 0.76. So the rising yield environment is not great for technology stocks. Now, the narrative is because when you value a share of any company, it's effectively a discount of future earnings. And now the rate at which you discount those future earnings matters. Now, with tech stocks, generally the earnings and the potential profits are quite a way off in the distance. But then if you discount those back, and if rates are rising, so the interest rate is higher and higher, and you're expecting it to be higher in the future, that means that the price you're willing to pay for those future earnings will be lower. So already tech stocks people were talking about them being overvalued, but when rates start to rise, then the price they would be willing to pay for those future earnings starts to fall, which means that the share price will start to fall, which is why we've seen this collapse in technology stocks this week. And so that diversification element I was talking about has been great if you're not overexposed to technology stocks, but you've got other areas of your portfolio that have done or fared less badly or occasionally done pretty well. If you've been exposed to commodities, for example, commodities are pushing up to, as a broad index, they're pushing up to like an 8-year high because of these inflation expectations that are now out there. So there are ways to diversify your portfolio. Now, where will all this stop? Because people will be looking at the rising yields, which are continuing to push higher, and think, well, technology stocks are taking a hit. Things like Bitcoin are taking a hit. The more speculative areas of the market are starting to fall, and it's starting to have a knock-on effect to things like the S&P 500. Yes, in dollar terms, it's not down by that much, but if technology stocks keep unraveling, then because of their size and influence on the wider market, then it will start to have an impact. We've already seen technology stocks, in particular in China, take a hit off the back of what's going on in the US. So where will this end up? Will it keep going? Now, the answer to that will depend a lot on central banks. So this week, Jerome Powell was giving testimony to Congress in which he actually stated that he didn't expect inflation to prove a problem. And in the short term, especially, it would probably be transient. So we would see inflation pick up. Commodity prices are rising after all. But ultimately, it wouldn't cause the US Federal Reserve to have to act and raise interest rates, which is what people are really worried about. Now, he said that he would probably end up keeping rates lower for longer and supporting the economy. The ECB has also made similar noises this week because they're growing concerned about rising government yields in the Eurozone. Now, going back and looking at history, when we've had periods where yields rise very quickly in bond markets, we've seen bond markets or government debt in particular sell off aggressively, where that's kept going and it's actually caused a wider equity market collapse has been when it's been due to, say, the US Federal Reserve or other global central banks saying that they're going to start unwinding QE or raising interest rates. And that causes the market to panic. We had an example that's been called the taper tantrum in 2013, where at that point the Federal Reserve said they were looking to perhaps start raising interest rates, and it caused a big wobble in bond markets and equity markets. It was because of that expectation that the central banks would pull the rug away from markets, because after all, what's been driving markets since 2008? It's been largely central banks' liquidity measures, and they've been pumping into markets. So at the moment, right now, it doesn't seem like we're at that stage. So perhaps in the next days and weeks, things will start to settle down. After Jerome Powell's comments, the market did rebound on the day. And so we have seen some signs of stability returning to bond markets, and equity markets, in particular technology stocks, started to calm down a bit. But we're not out of the woods just yet. Also, if you look at the 10-year US Treasury yield, we're hitting a level which would be called resistance, where it's a significant level where we are around about 1.4%. That if the market pushes above that, if the yields crash through that, then we could go much higher. But the likelihood is that that resistance level will prove difficult to break through. If we don't, then markets could reverse, so we could see the yields fall, which would obviously cause the 10-year US Treasury to rise, and equity markets could also take positive news from that and actually start to rise too, and see technology stocks rebound. So the message is watch what's going on in yields in the coming days and weeks. keep an eye on what's going on in technology stocks. But at the moment, investors have started to panic. But if history is to be any kind of guide, the reason why yields are rising really matters. So keep an eye on that. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien@moneytothemasses.com is the email address. Twitter is moneytothemasses with a number 2. We're on Instagram, Facebook, and of course you can subscribe to our YouTube channel.